Oh yeah, there you go. Nice, good
If I do it,
call.
then I'd forget.
Yeah, it's all good. And so right on cue, obviously, this new offering came up, and I know a lot of you when we were chatting in the UMSED, we're talking about like, can we learn a little bit about how stuff is underwritten, so that when we look at like the one pager, which is like, most of us have the time to just do that because you're on call and all this stuff. So maybe spend a little bit of time with Chris, who knows these things inside and out, to figure out where these one pages are derived from. So like what numbers is Viking looking at to then put this customer facing document together to kind of summarize it for people that don't have time to do all the underwriting. So that's what I thought we'd kind of do today, which I think, I used to be much better at it 8 years ago, and I was really into the weeds on this, but even I need practice. So I love looking at the one pagers and talking to Chris and being like, where do these numbers come from? And this way, hopefully, if we do this a couple of times, you guys will feel more comfortable looking at these executive summaries and knowing like either what questions to ask to the sponsors, or just kind of know in the back of your mind, okay, this is where that number is coming from. This is what it means. So, and since it's a small group, I think there's 5 or 6 or 7 of us here, you just feel free to, raise your hand, ask questions. Just like we were saying, try to poke holes in certain things and see if the answers are there. Because the point is to learn. The goal is to take the one pager and teach you how to know what's happening kind of in the back office to create these one pagers. So hopefully that's of value. I thought it'd be of value, and because it's a new asset. It's something that you'll probably hopefully end up seeing in a presentation or something, but you'll know more of the underwriting behind it. So does that sound okay, Chris?
Yeah, absolutely. And I mean, this is a pretty early look. Like we've just started like kind of launching emails out. We have a webinar coming up on Thursday. So no one has really seen the underwriting yet. So this will be a good practice session for me too, where I'll get to like dive in and kind of start explaining, see where people are having the most questions. So I appreciate everybody joining and giving me the opportunity. All right, so what I'm going to do is I'm going to start with a one pager, kind of go through it quickly. There's some parts that are like, who is Viking, which you guys already know. I'm going to kind of brush over those, and then we'll jump into the pro forma. So, just for anyone that doesn't understand the process, like when we're bidding on deals, there's essentially a buying process where you'll bid, you'll get into best and final. There'll be a buyer interview for the people that make it. They'll choose who they want to sell it to. And then we'll basically fly out to the property where our asset manager will, and start like the preliminary due diligence and start working towards building a purchase and sales agreement, or a PSA. That's where we are today. We plan on having the PSA signed by the end of the week. And from a marketing perspective, we try to get this stuff put together quickly so we can go out and do what we call a whisper campaign, and figure out how many people it's a good time for a new deal. Does this fit into their risk profile? Kind of work through things. So the first thing you see sent out from us is usually either a one pager like this or a link to the investment summary, which goes over the high levels of the property. It's going to go over the investor classes. So there's a couple changes to this deal. The preferred return for Class A has gone down to 9%. And the reserve class we've lowered from $1 million to a $500,000 minimum, make it a little bit more approachable. You have classes, how much Viking envisions bringing into each class based off of the total amount of equity needed, total amount of debt that's going to be on the deal, and the purchase price. Nice little graph illustrates all of that. There'll be a walkthrough of a $100,000 investment. I'm not going to go through all of this right now, but you'll have all this information. I'll send you this afterwards, or get it to Ankit, which just kind of walks you through, the cash flow and the equity split at the end. At disposition, this is the Viking, who we are, why we do what we do, our team, track record, which you guys have all seen before. And then this is just some salient points about the deal. So you have the historic low debt, which we're assuming a loan around 3%, which is kind of the backbone of this deal. Physical occupancy average. So this is something that as you do more of these deals, you realize that seeing 98% occupied, it seems good, but from our perspective, it's not good. That means that they're not pushing rents high enough. So this is a huge opportunity to increase rents. You'll always see some reasons why this area is a great place for us to expand our portfolio. This is one of the reasons we started looking at this property, and this is a typo. This was supposed to be a 7. No, we didn't put $60 million of value in 2 years. Elevate on Main, while it does have some issues with variable rate for the loan that was taken out for that deal, where we're up against the cap, and there's DSCR constraints, which we'll go over in the pro forma. I'll kind of show you how that affects a deal. But we've been able to implement the business plan and have almost doubled the organic rent growth and NOI growth that we anticipated having when we underwrote that deal. And we've created about $10 million in forced appreciation in less than 2 years, which is one of the reasons why we were more active in this area, and we want to grow our portfolio in the Indiana and South Bend, Indiana submarket. This is something we'll talk about in the pro forma as well. There's 2 phases to this value add. Now, being a core plus property, you don't have a huge value add component where you're spending like $8,000 to $14,000 a unit. This developer, when they built this property, they created a concessions program where they were basically paying the tenants electricity, water, cable, internet, trash valet, all things that are typically charged, and it's all contracted out. So they envision that basically we're paying those contracts, and what Viking will do, and what they're expecting this to phase out. It phases out in a way where their rent increases, and we basically get paid back for a lot of this stuff. So revenue is going to increase significantly, but without any additional cost to us. The second phase of the value add is going to be a light value add, probably in year 3, where we're doing like a tech package, Nest thermostats, or things to, kind of spruce it up a little bit, backsplashes in kitchens, lighting packages. It's a 2018 build, so a lot of this stuff, a lot of the new modern finishes are already there. But in 3 years, it'll probably be primed for something that can create, between $75 and $125 of a rent bump. And then it's just, information about why this area is a strong area. Also, one thing to note is anytime you have multiple properties in the same area, like we do in Atlanta or like we do here in South Bend, it gives you multiple exit options. Institutions are always looking to buy multiple deals at one time so they can save on their acquisitions costs. And your economy of scale is always going to help too, because as our property management team starts on one property, they build really good relationships. They learn a lot over several years. You buy another property in the area, they don't have to figure out that stuff again. They already know it. They've already made the relationships with construction companies, with people that come in and do the work on the property, and they've usually negotiated deals as they grow the unit count in that area. You guys know about bonus depreciation. One thing to note here, I don't know if you guys track it, but there's actually a bill that has been proposed, and hopefully it gets, approved, that will bring back 100% bonus depreciation, not only for 2023, but for 2024 and 2025. It won't phase out until 2026. So that's not guaranteed, but we all have our fingers crossed, because that would mean that for those of you that invested in McDonough, you're going to be getting more than you expected, and deals in this year and in the next couple of years would be back at that 100% rate that becomes really advantageous and helps build your longer term strategy. And then this is all, we'll cover all of this stuff in here, but this is typically what you're going to see, some variation of this, whether it's this or the investment deck. And then the real, challenge is kind of visioning and getting a hold of the pro forma and understanding why we feel bullish on the area, why we feel bullish about the complex. So let me go ahead and share my screen. I'm going to make the assumption that some of you have not, I know some of you have done these with me before, so you know the basics. But what I typically do is I just go through several of the boxes on the pro forma, kind of explain what's there. I'll usually pause, see if anyone has questions, and I'll jump around a little bit just to kind of show not only how the deal is constructed, but where I feel like, you should be looking towards as far as evaluating risk and how we're coming to the marketing materials that we're promoting and why we think certain things are attractive and we want to promote to folks. Before I get started, any questions with anything we just talked about?
Hey, Chris, this is Yuri. Question. I'm driving, so I'm not able to no, maybe stop. I'm driving, so I'm not able to look at the slides, but just listening in the past 8 minutes, one thing that occurred to me is if part of the value proposition of this is without having to do any value-added work, the concessions phase out. To me, it seems strange that the seller would want to get rid of this thing if they're basically with no additional work on their part. The assumptions are that they will retain their tenants, the tenants will pay more, their margins will improve. Do you all ever do some digging as to why people are selling, what their rationale is for doing this?
Yeah. So with this instance, it's the person that developed the property and they're at the end of what their original hold period was. So they want to exit their remaining portfolio. And like one of the things that happened here was, Vic really made an impression on the owner and like actually absolutely murdered the buyer interview. They chose us out of other bids that were significantly higher than ours. And it's not common to not win when you're the highest bidder. And they even want to potentially transact on some of the other properties they have in the area as they exit their portfolio and do those deals off market. So a lot of this is, broker relationships. I think one of the things that really helped here is that we have Main Street, which is like 20 miles away. And it's one of the comps. It's one of the things that they had tracked. So they had seen how well FCM was managing Main Street. They had seen how good Viking was in an area that it only had one deal in. So we were kind of outsiders in the South Bend MSA. And all of those things helped build a reputation where these people wanted to transact with us over other people that they had the option to sell to. As far as the concessions go, I don't know that these folks ever really had, they really should have rolled back these concessions years ago. Like they were supposed to last for like a year and a half or 2 years, and they just continue letting it ride. So I don't really know what the story is on why they didn't follow their original plan and start rolling back these concessions. But it's clear that the property is poised to roll them back because they're sitting on like a 2-month waiting list to get an apartment there. And when you are you're 98% occupied, you're only not 100% because of loss to lease, essentially, where there isn't enough time there's a couple units that are vacant while they're getting them ready for new units. But there should never be a waiting list at your apartment. Like you hope your apartment's operating between 90 and 95% occupancy. And if it goes above that, it's a pure signal that you should raise rents. Maybe this person's a little bit more altruistic, a little bit closer to home. I don't know, but we do view it as a huge potential upside for us to really, hit this one out of the park. Neil,
Got it. Okay.
So quick question, right now, since you're about to you're going to start the underwriting process, do you start with the syndication underwriting model or do you start with just a simple multifamily underwriting model?
So the way that we do this, we have our own in-house model that we use. And we have, we have Judah, we have Nathan, and then we have a backhouse team of folks that takes the first crack at underwriting. So they'll take the deal, they'll take our model, they'll plug everything in. And we're basically looking at, over the course of a year, 2,000 to 3,000 properties. So the ones that make it through the back house and they meet our buy box criteria from a cap rate perspective, from a per unit perspective, and then return metrics that we know that you all are going to require in order to find this interesting. Those will come to us to do an investment committee. So then once we have the framework for a model, Judah and Nathan will really dig in. They'll really dig into the T12 and the financials. They'll start asking questions to the seller and really finding out things that maybe don't check out or things that look a little odd on the trailing 12 or the in-place financials that we get given from the rent roll. And then Judah and Nathan, over the course of a couple of weeks, developed this model that becomes like our final internal model. But I think, we don't use like a form template or anything like that. I think it's overdoing the 24 deals that we've done. Our model has changed, and every time things get added, things get moved around that make it a little bit more efficient and make it, if we learn from any mistakes or things that kind of hurt us a little bit. So those of you that saw the McDonough model, you might see things organized a little bit differently, a little bit of extra information on this one because of that. Let me make sure. You need to get them new Apple Vision goggles. Yeah, 100%. That's like literally the only thing that they haven't been given. So, okay. So just to give a high level on these boxes on the left, you're going to have kind of the rudimentary information about the deal: address, vintage, rentable square footage, unit count. You'll notice the rentable square footage is important because as you're building your model and you're looking at increasing NOI and you're looking at some of the assumptions, when you're applying your assumptions to your gross income, you have to account for any lost revenue. It could be a model unit, it could be the time between tenants, it could be a tenant that isn't paying debt and you have a higher bad debt, or a concession that you've given out. Everything needs to be included in the model to be accounted for total revenue. So that's why this really gets measured. Sources and uses, these are always going to equal each other. And it's basically just telling you, the totals will, basically just telling you where the money is coming from, either equity, debt, or institutional pref equity, and then what it's being spent on and how much. Purchase price, acquisitions costs, and CapEx. In the tabs, they'll get more granular. And you'll see exactly what we're spending on CapEx, exactly what the costs are of acquisition. Purchase price is pretty self-explanatory. As you go down, you have the equity breakdown. So if you remember back to that one pager where we had that nice graphic with pictures that showed how much of each share was going to be available and what it was going to provide, this is that in a financial accounting modeling sense. How much of the total equity is going to be Class B, how much is going to be Class A, how much can be reserve. When reserve and Class A tap out, only B is left. So you'll notice that, like on McDonough, some people wanted to get into Class A as we were closing it down and there wasn't any available. The reason for that is because we're limited to the amount we can take and still be able to pay that current pref amount and prioritize cash flow. The institutional pref equity on this deal isn't relevant because we're not using pref equity. So these numbers are just kind of left in here from the last model. Any questions so far? Okay, purchase price metric. So this is an important aspect of these deals. And it's like the first, talking point where you can kind of evaluate, risk and how conservative or aggressive somebody's being. So purchase price, $33,250,000. When we originally started looking at the deal, the broker whispered 33 million. And we ended up paying 33,250,000 due to the competitive nature of the deal. The trailing 12 NOI, so the trailing 12 financials that they gave us annualized was 1,964,889. And the way that the formula for coming up with that cap rate is taking the purchase price or the perceived value, dividing by the T12 NOI, and that's going to give you the entry cap rate. Getting this near a 6 cap is unusual, even for this market. It's a really high cap rate. It's one of the reasons why we felt like we got a really good steal, especially if you factor in a lot of the revenue that's going to come organically through charging for things that we're always supposed to be charged for. Now, when you go over to the sales side, it's the inverse of this. You're trying to figure out a conservative exit cap, which in this situation, we feel like we've gotten the peak of the cap rate, and cap rates are going to start compressing during our 5 years of holding the property. not extravagantly down to like a 4 or 4.5 or 4.75, like what we bought Main Street at, but within about 40 basis points of what we bought at. So we think we're getting a really good deal on it. Now, in deals in the past, as we were in an expanding cap rate environment, you'd notice that we were purchasing, like we purchased McDonough at a 4.75 cap. We expanded 50 basis points on that one because we feel like we bought at a reasonable cap rate. We didn't really get the same kind of deal on that deal as we got on this deal. This deal, we think we're going to end up exiting at a lower cap than we bought at. So that's one area where you want to kind of look at risk, because you really, as the investor, need to look at the area and try to figure out if you think cap rates are going to compress or if you think they're going to expand. And later when we get through the model, there's a table here that shows you what happens if we're off. If it goes all the way up to where we purchased at, what are the returns? How does this affect you? And if we're off in a better way, where cap rates compress even more than we're anticipating conservatively, what does that mean for you and your returns? Now, before we get into the revenue and expense escalate, real quick, any questions there? Because I know that was like, that's usually like more of an important topic. Okay. Before we get into some of these assumptions, I wanted to go to the annual cash flow tab and just kind of walk through how this looks in the model. So
Chris, I do have a question. When you're going into an area that you've never gone into before, do you rely on brokers for guidance on the cap rates, or does Judah or Nathan or the team kind of how do you figure out like where it's headed and that kind of stuff?
So it's more broader than that. So we will rely on brokers and try to get transaction data to see what things have been trading at in that area. For us, we had bought a deal in that area a year and 8 months ago. So we knew what cap rate we bought at. We knew what we underwrote to exit at in 5 years. And then you look at sales comparables, you look at what things are trading at, and you look at the kind of NOI growth and what's going on in the area. Is it going to become a stronger economy or a less strong economy? This one's a little bit tricky because it is a tertiary market that's close to some pretty major markets like Chicago and Detroit and Indianapolis. And it has a lot of, universities in the area, kind of like Raleigh does. But I don't anticipate this going like into the low 4s like you'd see in an Atlanta or a major market, but a mid 5 is probably where this should have traded at. I think we would have probably passed at a 5.5 cap, but we pushed really hard and won it at close to a 6 cap, and that was right in our window of, we have the opportunity for this to be one of the better Viking deals. I don't think we've ever bought like a property that is a 2018 core plus asset at a 6 cap in any market. But yeah, you look at everything and any information you can get your hands on, reaching out to the city, trying to figure out what kind of development's happening in the area, how are the city's bonds rated, like all of this kind of information will give you an inkling into the health of the city and the surrounding areas. And then you're trying to understand what drives employment, what drives household income, and if there's going to be job creation in the area, which, all things, look good for Indiana as a whole and specifically this MSA. So here, what we're really going for.
Hold on, I think Emil had a question.
Oh, I'm sorry.
And just a quick question, kind of what Ankit was brought up.
Mm-hmm.
In the multifamily, there's no place you could buy information regarding vacancy, rental rates, and stuff like that.
Oh yeah, you can, and that's a lot of that information. Like you can, if you go and look at our rent and sales comps, like we have a lot of that data. We have what things are selling for in the area. We have the data, like in a CoStar report, you'll get a lot of that remedial data, but a lot of it's things that have already happened. It's not really an indication of what's going to happen in the future. You can track historical historicals, but you really need to, like, for instance, like when we underwrote Main Street, I think they were like way conservative in the amount that they thought they were going to get, be able to create rent bumps and have rent growth. And the area did really, really well. And they nearly doubled what they did. But when you're doing this deal, like, you don't want to move away from how conservative you typically are just because there's a chance that you could be better. You want to stay conservative because under promising and over delivering is always going to give a really vibrant investor base and help you build trust. You can do that for 10 deals and then over promise and under deliver on one deal, and it can ruin everything. So we're going to tend to play the conservative approach while also being realistic.
Hey, Chris, can you hear me?
Yes.
A follow-up question on your all's market research. It sounds like, just from my passing glance, I mean, there's multiple margins of safety you guys have built into this deal. What I'm curious about in terms of your ability to look at comps is, it seems like a major kind of wave that's happening nationally is new build multifamily. Right. I'm wondering if you guys have visibility into new build multifamily in this area to get a sense of supply demand matching in the near several years that this investment's going to be held.
100%. That's something that we track. And that's public information because people, in order to build new multifamily, have to pull permits. So there is a project that's going up near ours that's, I believe it's 60 units. They're nicer units, but 60 units with no amenities. There are no other really comparable properties that have the same amenities. Like if you live in this area of this submarket and you want to live in a nice, newer, modern building with nice amenities, there isn't much competition. That's one of the things we love about this deal too.
Gotcha.
It will come online, but it's not going to be coming online within the next 18 months.
I see.
Okay, so going through this, gross potential income is going to represent if every one of those rentable square feet was rented and it was just fully 100% occupied at the market rate that we have 100% complete. This is the most money that can be made. Once you get that figured out, you essentially have to start deducting your negative assumptions. So loss to lease, which is the time between, really the amount of lost revenue between leases. You have vacancy, which is self-explanatory, whatever's missing from your occupancy rate. Concessions, which, in this instance are, pretty significant. Although it's a little bit strange how they're built into the deal because they're really not built in as concessions. They're built in as included contractual obligations from the sponsor. You have models, office employee units, and bad debt. So once you get through all of these assumptions, you're left with your effective gross rental income. You're going to have other income, which is going to be, a garage that maybe is an extra fee, or washers and dryers that are an extra fee. Cable income, valet trash. So these don't exist right now. The cable income and the valet trash in their T12. This is something that we're going to start transitioning to in year one. So you'll notice from year 1 to year 2 to year 3, this is growing significantly in year 1 to year 2 because the people that are already in a lease under the old rules are not going to be, their deal isn't going to be ripped from them. It's going to have to wait until the next renter comes in to transition into having to pay those fees. So then you end up with your total net income. Then you have to pay all your liabilities, real estate taxes, insurance, electric. You guys know these. And what you're left with is your NOI. So the NOI is important because that is the crux of forced appreciation into these deals. It's year over year increasing NOI through the hold period. And that increase in NOI multiplied by your expected exit cap rate is what's going to give you the growth in value. So from the end of year one to the end of year two, roughly $4 million. $4 million over the next year, about 3.8, all the way to year 5 of 48 million. With the purchase price, so 10 million over the course of this whole period. The other thing that is worth noting on this annual cash flow tab is you have your debt service, which is going to come next. And why this is important is because once you have your net operating income and then you subtract your debt service, you're left with your DSCR. And if any of you guys have talked with me about any of these deals, I always feel like DSCR is probably the most important thing to get figured out from the get-go on a deal that you're looking at investing in, because there's really only one way for you to lose your principal and for you to lose any hope of a return. And that's if the sponsor, Viking in this instance, has a really low DSCR, like 1.25 or below, and something goes wrong and we can't pay our debt service and the bank forecloses, takes their collateral, which is the property itself, and all the LPs get wiped out. So a red flag for DSCR is between 1.25 and 1. Anything below 1, it's like the deal doesn't exist. They can't even make one, monthly debt service payment based off of the financials. You'll notice this deal with the attractive debt that we have and almost 2 full years of IO. Year 1 and year 2 are well over 2. And then the average over the 5 years is like 2.03. So it dips a little bit in year 3 when we start paying a significant amount of the principal and it fully amortizing essentially. Year 4 it gets a little bit better, and then in year 5 we get back over 2. But never does it get into a danger zone. So what you can confer from seeing these types of DSCR numbers is the big risk that you're taking by investing in a deal like this is, are they going to be able to increase revenue the way they hope to increase revenue and create the amount of return that I'm expecting? I'm not anticipating, even in a worst case scenario, losing my principal on a deal that has this high of a DSCR. The opposite would be true if it was low.
When you get to year 3 though, what interest rate are you using?
So the interest rate doesn't change, it's fixed.
Oh, okay.
So the interest rate's the same, but what does change is that in year 1, the entire year, we have interest only, where we're not paying any principal. We're just paying the interest. In year 2, we have a portion of year 2 is still covered by IO, and a portion of year 2 we're starting to amortize, but it's only several months of year 2. So you have principal payments starting, and I think it's month 8. And you're paying those principal payments, you're basically fully amortizing for several months of year 2. So that's increasing your debt service. So when you look at a deal that has variable debt, like if you look at those Houston properties that just recently went belly up, where it was like 3,000 units and all the investors lost all their money. They were using variable debt. And if you look at this, they could have been operating with the best of intentions and all of this going according to plan, and their NOI growing month over month, and everything was going right. But their debt service went from, in their case, it tripled. It went from like 3% when they bought it to 9%. So if this $900,000 of debt service on a flip of a switch over 3 months goes from 900,000 to 2.7 million, guess what? You're not going to be able to pay your debt service. So that's one of the reasons why variable debt, like you always want to look at the DSCR. The DSCR is going to a certain extent, show you what kind of risk you're taking, but you also want to know what kind of debt you're taking. Like, first of all, like Freddie and Fannie, the agencies, will not lend to a sponsor that is DSCR constrained. So if they have below 1.25% DSCR, they're not getting a loan through one of the agencies. They're going to have to use a debt fund or some other kind of more aggressive, slightly more predatory debt. And that would be a red flag too. You might Now, if it's variable debt, you're basically making a wager against what is the market going to do. If interest rates, like we saw a hike in the federal funds rate quicker than we've seen in recent memory, maybe in history, because of how badly the Fed wanted to combat inflation. A lot of sponsors didn't think about that. Like they didn't think that, they looked at historical trends. They're like, okay, well, maybe like over the course of 2 years, they'll increase and we'll eventually take care of inflation. Well, worst case scenario happened. And if you didn't have a rate cap protecting your exposure, which those things don't come cheap, like the rate cap that we had for Main Street, because Main Street used variable debt. The rate cap we had for Main Street was close to $1 million. It's like $900,000. So you do what you have to do to protect yourself, but fixed rate debt is always going to pose the least amount of risk, because even with a rate cap, they expire after a certain amount, maybe 3 years, 4 years, whatever it is, they expire. Then you might have full exposure again. With fixed rate debt, especially in this deal, we're looking at a 5-year hold period, but we have 7 years of this debt. You're really reducing the amount of risk. Typically, you lose returns when you decrease risk. It's like a sliding scale. If you're taking more risk, you're getting more reward. This deal is a case where the low debt and having the IO really helps the cash flow. So this deal is a newer vintage than McDonough. It cash flows better than McDonough. Even though McDonough was a pretty low risk investment, this one has even less risk. And because of some of the dynamics of the deal, it's going to produce similar returns. I think the returns are almost spot on with what McDonough was going to do, but in a much safer, newer property. So, this is really what I wanted to show you guys here. Is there, did you guys have any other questions about this tab? No? Okay. Go back.
We're kind of at like the 15-minute mark, Chris, and I'm definitely gonna, for the last 10 minutes, I want you to just like tell us the biggest things that scare you about this deal. Just take the gloves off and be like, this is kind of the big, there might not be anything, but I just want you to just be like, yeah, these are some of the things that I might be a little worried about, just so we
absolutely.
So,
that's easy.
Yeah, keep going. I'll give you a 10-minute warning.
I'm going to highlight a couple other things just on the pro forma, because I want to get to these. The revenue and expense escalator, you're really looking at the organic rent growth here. So you notice in McDonough, we had 4.5% and 4% in years 1 and 2. Here we went down to 3% because while we are going to get the revenue increase from those concessions rolling back, we really don't see this property having such extreme rent growth that we should go outside of the market standard. And then also on the loan term, while we are getting the assumable loan at 3.08% of 18 million in proceeds, we do expect Freddie Mac to offer us a supplemental, which is going to come at a higher interest rate. So the total blended interest rate for this deal will still be sub 4%. So one of the things that is an indicator of if a deal has positive leverage or not is going to be looking at the purchase cap rate and comparing it to the interest rate, and if that interest rate is variable or not. So this is something that you saw this kind of spread like in 2020 and 2021. Like even in McDonough, we didn't have this type. We were buying at a 4.75 cap and the interest rate was 4.11 all in. So it's just 50 or 60 basis points. Here you have almost 2 full points, which is, pretty good indicator. Yes, Yuri.
What can you explain why you all anticipate needing to take on supplemental debt?
It isn't that we need to take on supplemental debt. So if you look at it like the sources and uses, right? So say this was 4.5 million less. We'd be raising 19 million instead of 23 million. The cost of equity is going to be from an average annual rate, at minimum 14%. This is like the low end of our range. It's probably going to be somewhere between 14 and 20% is what LP equity is going to cost us. It's a no-brainer to take $4.5 million more at 3.89%.
Gotcha. Okay.
So you want to increase your proceeds, but not if it's going to affect your DSCR. So where you wouldn't want, like if this was 85% debt and we had hardly any equity, we wouldn't raise very much. Investors would be making a lot better returns, but the DSCR might be down to like 1.2. And then if something happens to the project, that's when you see a group doing a capital call or pausing distributions because they're worried about being able to pay their debt service.
And when you quoted the 3.9%-ish, are you talking about the blended rate or the supplemental?
This is the blended rate.
So so to reach that blended rate, you're just kind of quoting whatever the market rate is for $4 million of business debt right now?
We have a preliminary quote from Freddie Mac. It's 5.75. So they'll match the term exactly. So it'll be the 7 plus a few months of remaining.
It might just be, Chris, it might be that Yuri can't actually see the spreadsheet. So that's
no, I can see. I can see it now. Yeah.
Okay. All right. Then he's just slow. No, I'm just kidding.
That's true. True.
So yeah. So and then you look at what your blended rate is, and it's really going to be based off of the new rate that they give you with the exact same terms, blended with the original assumed rate that you're assuming in the loan. I don't believe it. Yep. So wanted to show you that. Other than that, you have the renovations. You have these are assumptions too. So this is, Ankit asked me to kind of talk about where the risk is in this deal. And really the risk lies in being wrong about these things. Really this box and this box. So we feel like we're being pretty conservative. Usually revenue is commensurate with inflation. I think inflation's higher than this, but it's probably not going to get lower than that. You also have to take into account that renters are going to have to be paying for more things than they used to be paying for. So that might get absorbed a little bit into this rent growth. So even if inflation's at 6% and we're charging them for trash valet and electricity and things they weren't paying, it's going to be kind of a process. So that's why we're a little bit more realistic here. Loss to lease, we're not doing a lot of renovations, so we don't have a really big bump here. But if for whatever reason, we start rolling out this program where people have to pay things they're not used to paying, and velocity slows down so quickly that a lot of people aren't renting, and we go to 90% occupancy and we have to introduce some sort of concessions to get people in, maybe we're a little bit off on these numbers. These will affect total revenue, and that total revenue, if we don't build the revenue that we plan on building year over year, then you're going to have a lower return. That's just, the mathematics of it. So I would say one risk is transitioning into rolling those concessions back leads to a little bit more vacancy and potentially a little bit more concessions, because at a certain point, if vacancy starts dipping, we will build in some sort of concession, get a month free if you rent, or some sort of discount. That will have to be accounted for. And then another risk in these deals is typically bad debt, but in a 2018 build, you have a pretty good tenant base. They're pretty expensive for the area, more expensive units than typical. So you usually don't have a ton of bad debt. It's really going to be vacancy. The other place that we have risk is, like we discussed before, the cap rate. We truly believe that we're getting an exceptional deal on this, and we're not going to sell this at a cap rate even close to what we bought it at. We're going to be in this range between 5.25 and 5.5. We could be wrong. There's a risk there. Like maybe this guy that's selling it knows the market better than us, and cap rates keep expanding. The Fed doesn't get inflation under control. There's some, continued major crisis where the Fed continues to keep interest rates high. We don't have a risk of being forced to sell this because we have such attractive debt for 7 years. But if Viking wanted to exit at a suboptimal cap rate, there'd be some risk there. There's really no interest rate, stuff going on, but really, most of the risk in this deal revolves around this business plan, which is turning around, creating revenue through taking away these concessions. That's really where the risk lies. And I don't think it's really that much risk. As you look at the sales metrics, we're anticipating creating 10 million or so of value. And the way that this works is the inverse of the purchase price metrics. You multiply the exit cap, you account for the closing costs, you pay off the disposition costs, any remaining proceeds on the loan, and what you're left with is the net proceeds. It goes 70-30 or 80-20, depending which class you're in. If you're in Class A, you've gotten your 9%. Your deal level IRR, the low end of our range, I think in our marketing materials was 1.6 to 1.8. This is right in the middle. But typically on these, this is at the bottom. So I think we're being conservative there too. Average cash on cash of 6.2, pretty attractive, I think, in this market. I think that pretty much covers it. Are there any other questions?
This was awesome. Thank you.
Of course. And I know, we're a little bit pressed for time. I'm happy to jump into this individually with anybody over the next few weeks. If you want to learn more about this deal, I'm sure, Yuri, you have more questions. So
fair enough.
I'm happy to jump on a call and dive into some of these tabs more granularly. I know it can get a little bit in the weeds when you're going through some of this stuff, but when you're looking at the rent roll and you're looking at the T12, there's still things that you can point out that, like when Judah and Nathan are underwriting these deals, these are things that they're looking for, and they have honed their ability to find, aspects of deals that we've found in other deals that have been really advantageous, and that we can kind of reverse engineer. Okay, this deal did really well. We got a 2.2x. What happened? Did we just get lucky? Did we, kind of overlook something? Are there ways that we can pinpoint other deals like this? But the truth of the matter for this deal is it's really low debt with a long duration that reduces the risk. It's still a solid return, albeit not as solid as you would have gotten when deals were levered like 80%. And you were getting like tons of bonus depreciation and a 2x return. That's not here, but it's also not a value add deal that was built in 2005 where you're doing a super heavy lift on a value add to 400 units. This is, at least from Viking's perspective, this is a nice, easy deal. Our asset manager loves this deal. He's barely going to have to do any work on this deal. From the perspective of comparatively. So, all right. Well, I think we can wrap up.
Yeah, that was awesome, man. Chris, that was perfect. That's exactly what I was kind of hoping to get out of this again, get a nice under the hood look at where those numbers from the one pager come from, and just get a nice walkthrough. If you guys, there's a lot covered, and I think sometimes watching it again or something is good. We'll try to make the recording available to you. I think that should be pretty easy to do. So just shoot me a text or email me or something. We can send it out. I don't know if our webinar thing does it automatically. I actually don't know, but if that's something you need, we'll find a way to get it to you. And also, if you have any, I know Neil's been doing a couple of these. Neil, if you have any feedback on doing this for investors, let us know, because we'll probably use this recording when other people ask, because I think he did a great job. Honestly, he covered everything on that sheet. So just let us know if there's other stuff you want to know about. Thanks for coming.
Thank you, Chris. That was awesome. You're very generous with your time. So thank you for doing this again. This is great.
Of course. Yeah. Appreciate that. Well, everybody have a wonderful night. And like I said, reach out anytime. You guys should all have my personal cell. I'm happy to chat through anything Viking.
Thanks, Chris. Bye-bye.
Good night, everybody.